All right, and just so everybody knows, we are recording the call, and it is 10 o'clock. So again, thank you everybody for joining us. And I am now going to pass this over to our CEO President, Mr. Dan Bowman.
Hey guys. Well, this is a little bit different. This is a new thing for us. I think we had something like 70 people lined up to participate on this call, so it's a big deal. As Joe had pointed out earlier, since COVID and Zoom came along, we can do all kinds of things we couldn't do before. We had talked about how do we, get out and sit down with our customers and talk about what's happening in the industry, talk about what's happening in the bank, talk about what's happening with interest rates, etc. And what we figured out is that boy, if we had a meeting every day, it would take us quite a while, and it might not be as timely as we'd like. So someone came up with the Zoom idea, and anyway, so we're going to give it a shot. With that, I'll jump into it. And first of all, we've got the disclaimer saying this is not legal advice, this is not investment advice, this is conversation, and that's the idea. And as Glenn pointed out, we'll go through. I've got some PowerPoint slides here to talk about some things, and then at the end we'll open it up for some questions. And I'd like to keep it within 60 minutes, and I recognize everybody's time is precious, and so we will try to get through this in a timely way. Got a lot of stuff to cover in a short period of time. So anyway, with that, let's jump into it. And I guess the elephant in the room is what is with banks. As we saw Silicon Valley Bank not long ago, of course, Signature Bank, both of those, Silicon Valley happening on a Friday, Signature happening on a Sunday, strangely enough. First Republic, first thing Monday morning, etc. And then Credit Suisse, not a domestic bank, but the second largest bank in all of Switzerland, with a structured sale. So what is going on in the banking industry? And unfortunately, this isn't helped by some of the talking heads on the news feeds. I get up in the morning and ride my stationary bike and listen to the news, and there's always some quote unquote expert there saying every bank is going to fail. And with 4,300 banks, that's a pretty broad statement. How do you summarize them all in one? But at any rate, so let's look at the primary risks of banking, and there's only three. Credit risk, of course, and that is we make a loan in which the borrower defaults and cannot repay the debt, and that's historically been the biggest issue for banks is credit risk, and it's very hard to work through those, very hard to mitigate it. If a loan is bad, a loan is bad. The second area is interest rate risk, and of course that's where you make a loan for X, and then interest rates move higher, and your net interest margin compresses, or maybe it inverts. We saw in the 80s how we inverted a net interest margin in which savings and loan industry had 6% mortgages and 15% CDs, and it was devastating to that industry. And then the final primary risk for banking is liquidity risk, and that's because we get our funding on a short-term basis from depositors primarily, and then we make loans on a long-term basis. And so the difference between those two is potential liquidity risk. And that's the classic, the run on the bank, so to speak. If anybody's watched It's a Wonderful Life. And that's where more depositors want their money back quicker than loans are repaying, and that's where the bank gets pinched. So the issue where we're dealing with in the industry today is interest rate risk. Now, it has the potential to roll over into liquidity risk and into credit risk. Right now, at least, the headlines that we're dealing with are in the interest rate risk category. And, the poster child for this is First Republic Bank. Now, this is, by the way, the second largest bank to be seized in American history, $232 billion in total assets. And First Republic's business model was they made mortgage loans, 30-year fixed-rate mortgage loans. And they did a lot of them. and they were at a very low interest rate. And the model was that we will make a mortgage loan to a high net worth borrower, and in exchange, he'll deposit with us and we'll give him a preferential rate. And as a net result, because a lot of these loans were partially self-funding, you could get a net interest margin that was pretty close. And it was a well-oiled machine, provided that interest rates didn't go up. Unfortunately for First Republic, interest rates did go up. And we can see on their net interest margin, now this chart shows it in billions of dollars. So they peaked at roughly 1.3 billion on quarterly net interest margin. But then we saw subsequently it dropped significantly. Now, again, this is nominal or in dollars. If we look at this same chart as a percent, we can see that First Republic peaked out about 2.62% on the net interest margin, and then quickly dropped down to 1.3 as of the first quarter. Now, keep in mind that 100 basis point difference or 1% difference there, most banks operate on about a 1% return on assets. And so when we see a 1% decline in the net interest margin, it quite likely translates through to no earnings left, or you've compressed it down. So, in summary, the challenge for this particular bank is they made long-term fixed rate mortgages. They had a high net worth, volatile depositor base. And the reason I say volatile is because they were fairly large depositors, and a tight net interest margin. And those combinations in a rising rate environment resulted in insufficient liquidity. There were too many deposit withdrawals and the compressed net interest margin to overcome. The bank, of course, was sold to JP Morgan Chase. It was a good day for JP Morgan. They made, depending on the end of the story, something like $20 billion on this transaction, provided that they can go through the interest rate cycle. The next one, of course, high-profile Silicon Valley Bank in Northern California. This is a bank that specialized in tech. If you had a tech startup, chances are you banked with Silicon Valley Bank. You got credit from them. They helped facilitate the underwriting of stock issuance, initial public offerings, etc. And it was very big dollars, about 200 billion in total assets. So it was a very big bank. The problem was their depositors were also very big. Their largest depositor had approximately $10 billion on deposit with them. I don't know about the rest of you, but if I had a $10 billion customer, I'd get up every morning and give them a call and see if they needed anything. Coffee, I don't care, I'll do it. 10 billion is a lot of money, and it's a volatile depositor base, because even if somebody changed their mind and went to the bank across the street, $10 billion shift in deposits would be catastrophic to a bank, and this bank suffered that same fate. They also had an institutional shareholder base, so they had relatively few shareholders with very large holdings, and when that began to migrate, it was devastating. And then finally, the interest rate risk of the investment portfolio. In a strange sort of quirk, they bought the most safe investments you could buy, U.S. Treasuries. The problem with U.S. Treasuries is they've got a high interest rate risk because there's no cash flow coming off of them. They tend to be bullets, meaning they run to maturity and then they repay final principal and interest at maturity. And so they tend to be more volatile than other kinds of investment like mortgage-backed securities. And so the volatility of their investments, coupled with the volatility of their deposit base, just ruined that bank, unfortunately. This is a tweet, and this goes back to January of 23. One of their shareholders is saying Silicon Valley Bank hold-to-maturity securities had a mark-to-market loss of 15.9 in the third quarter. Compared with just 11 billion of tangible common equity. So that's suggesting that they had a negative. Luckily, the regulators don't force Silicon Valley to mark, but the bank would be functionally underwater if it were liquidated today. So this is one of their shareholders tweeting to another shareholder about the issues with this bank back in January. And of course, the bank wasn't ultimately seized until March. So there was a lot going on. You can, go back and see communications and things up to a year earlier. So it didn't sneak up on anybody. Another one in the news, and it's different from the others, Pacific Western Bank. This one's interesting to us because it's local. Frankly, they're here in town. They're in our Upland branch. They're across the street from our Upland branch. And so what is happening with them? And the challenge with Pacific Western Bank is that they've got a lot of institutional shareholders. And if you see the compression in the net interest margin and your investor base starts to want to liquidate positions and you have relatively few, relatively large shareholders, it devastates your stock price. And in this particular bank, they saw a 66% drop in their stock price in just a few trading days. And that's when rumors and speculation starts and people say, oh my gosh, did you hear about Pacific Western? They're in trouble. What does that mean? Well, it means their stock price has dropped a lot. Now, that doesn't mean fundamentally the bank is profitable or unprofitable. It means you've got an exodus of shareholders. And but unfortunately, that kind of rumor leads to liquidity problems. So with that in mind, what is the Federal Reserve's response to this? Janet Yellen has been pretty vocal, trying to calm folks down and reassure them that the banking system is sound, it's healthy, etc. With somewhat mixed response. But so Silicon Valley Bank was seized on Monday. On Tuesday, the Federal Reserve came out with what they called their bank term funding program, and this is to answer the liquidity issue. And keep in mind, liquidity isn't about investments or loan quality. It's just about, I've got, depositors that want to get their money back, and I can't get the money out of the loans, so I need to borrow from the Federal Reserve. And this program is interesting in that it's designed such that banks could borrow 100% of par value. And remember, I talked about Silicon Valley bought U.S. Treasuries that decreased in value because of interest rate. Well, this allows them to borrow at par, or 100% of the purchase price, or the original price on that bond. So it's quite possible you have a bond on your books that the market value is 80, and you're able to borrow 100 on those. So this gave tremendous liquidity to the banking system. It's also at fixed interest rates for 12 months, and there's a rolling 12 months. So if I were to borrow today, that would mature in May of next year. No prepayment penalty. So if interest rates go down, you can liquidate your position on this. And it's priced at the 1-year overnight swap rate plus 10 basis points or 10 bips. That, by the way, recently we did a transaction at 4.37% fixed for 12. And so it's very friendly collateral. It doesn't require much setup. You can do it literally within an hour. And so this has gone a long way to helping the banking system get the liquidity it needs to meet deposit demand. So with this all in mind, how did this all start? Back in December, October, or something like that, there wasn't all this speculation about banks. Why all the issues? And it goes all the way back to 2009. So I went on the Fed board beginning in 2008, and at that time, the Federal Reserve's total assets were roughly $1 trillion, actually $983 billion. And they had been that level for a long time, just hadn't changed. Well, in 2009, Ben Bernanke was the chairman of the Federal Reserve at the time, and he figured out he had a checkbook. And he could write checks on this and buy assets, and he did. And they more than doubled the total outstanding assets of the Federal Reserve. And when you think about outstanding assets, it's printing dollars. So they printed $1 trillion in 2009, and began buying assets on the open market. Well, it went on 2013 through 19. Those are good years. The recession was over. We were back to prosperity. There were some very good years in there. And the Fed continued to expand its balance sheet, almost doubling it again. So in 2019, you're at 3.7 trillion. Wait a minute. If we're in good times, why are we continuing to expand the money supply? And in my opinion, it's because the Federal Reserve is shifting the tax structure from income taxes to holding mortgage-backed securities. And keep in mind, the Federal Reserve has purchased in total about $5 trillion in mortgage-backed securities. So when people like me make their mortgage payments, it goes through Fannie and Freddie and eventually back to the Treasury. And so we've got a cash flow now going directly from homeowners to Treasury. And then when the pandemic started, all bets are off. Now, the Federal Reserve could expand the balance sheet with impunity. Nobody asked a single question. Congress didn't dispute it. Nobody understood it. And the Fed expanded their total balance sheet from 3.7 to 8.9 trillion, or about $5.2 trillion in just 2 years. And we've never seen that before. The Fed has never expanded the monetary base by 140% in 2 years ever. I go all the way back to World War II. We didn't do that. So this is new ground for us. We've never seen this before. And there's frankly no discussion about it at all that I see. There's a lot of discussion about a lot of other things, but not about expansion of the monetary supply. And in my mind, this is critically important. So if we look at, in addition to the Federal Reserve expanding the total monetary base, we have the federal government expanding the total amount of debt. In the beginning of the pandemic at 2020, we had $23 trillion in total federal debt. Well, in just 2 years, that ramped up to $31 trillion in total debt. And currently, there's a lot of controversy and discussion over passing a debt expansion bill, and under what terms and what conditions. And the administration's made it very clear they want to continue to deficit spend at a rate even faster than they were deficit spending before. And so we are expanding through federal deficit spending and Federal Reserve asset expansion. We're increasing the total dollars in circulation by an extreme amount. In this particular case, a 52% increase in federal debt in just 2 years. We see bank deposits, same thing. If we go to 2020, we were at about 13 trillion in total domestic bank deposits. They peaked out at 18 trillion. So there's that 5 trillion again, or 38% expansion in bank deposits. And keep in mind, bank deposits were at virtually zero. If you look at Fed funds, we were at 8 basis points. And the Federal Reserve continued to say, my friend Janet would continue to say, inflation is transitory. This is not an issue. This is nothing we need to be concerned about. And we have the tools to deal with inflation. Okay, well, everyone settled down and we started to invest that $5 trillion of excess liquidity that was pumped into the marketplace by buying treasuries and buying investments and making loans, etc. And then all at once, the Federal Reserve said, oh, maybe CPI is a problem. We can see the consumer price index here that went from an average of 2.46 before the pandemic, that now recently core CPI, meaning this excludes food and fuel, has shot up to 6.61%. 6.61% on the core would suggest headline inflation is more in the range of 10%. And if we're at a 10% headline inflation and interest rates are lower, what you're doing is you're paying people to borrow. So as a result, the Federal Reserve started cranking up the Fed funds rate. And we can see here, this chart goes all the way back to 2009. And the Fed funds rate was fundamentally at zero. We were at 0.08 of 1%, or 8 bips for 7 years here. And I think we all knew that. You'd see, banks were paying 1% on deposits. and making loans. 30-year fixed rate mortgages averaging as low as 2.6%. And it created, over a 7-year period of time, it created an assumption of longer term interest rates. And we got into 2016 through 19, and the Fed began moving rates higher, and they only went up 250 bips. And the pandemic hit and everything dropped sharply again. And so for the next year and a half, we're back to 8 bips, or almost zero interest rate, until we got to the beginning of 2022. And in January 22, the Federal Reserve began increasing interest rates at a startling rate. And if we look back historically, the Federal Reserve has increased interest rates at approximately 25 bips per meeting. Sometimes they'd skip a meeting, but they'd tweak it by 25 bips and they'd see what happens, and they tweak it and see what happens. In this particular case, the Fed did a series of 75 basis point increases in the Fed funds rate, or at 3 times the speed that they had prior done it. And like many things in the world, I can handle $3 gas or I can handle $5 gas. It's when it rapidly goes from $3 to $5 that it's hard to adjust. And it's hard for the world. It can deal with an 8% or an 8 bips Fed funds rate or a 5% Fed funds rate, but it's that rapid movement in between, because I've made investments and plans and structures based upon 8 basis points. And it's that rapid change that causes us trouble. Today, the Fed funds target range 5.25 is the upper limit on that. That's a lot. And the Fed is indicating that there could be more in the works. Now, I have the either advantage or disadvantage of being old, depending on how you look at it. This chart goes all the way back to, I think, 1965. And this is the effective Fed funds rate on a weekly basis. And we can see that in 1983, we hit some pretty high numbers here. I remember, I've told this story a number of times. I remember in 1983, I was taking a night school class at Cal State in cost accounting. And it was one of those classes that starts at, 7 in the evening after work and goes till 10. And, you're just trying to stay awake on coffee. And we're in a break, and some of the guys are standing around talking. And one of the guys said that this past weekend, my wife and I bought a new house. And everybody, congratulates him. And one of the guys says, "So did you get locked in on your interest rate?" And he said, "Yes, we got locked in. We got locked in at 17%. And everybody in the crowd said, "Ooh, that's good." And, for a long time, we wouldn't pay anything above 2.6%. And so we have had periods of time in which we had rapid escalation in inflation and rapid escalation in the Fed funds or the cost of credit to overcome that. And if we look back in 83, inflation peaked at 18%. And in fact, I remember at the time there were discussions about don't pay your property taxes, you can reinvest it elsewhere, and you'll make more money on that investment than the penalty for paying your taxes late. But fundamentally, the cost of credit has got to be higher than the rate of inflation. And if it's not, what you're doing is you're paying a borrower to borrow money. And if you pay them to borrow money, they'll borrow a lot of it. And we saw earlier how the Fed funds rate for 7 years was at 8 basis points, but inflation was at 2.4. What we did is we created an incentive to borrow and buy assets. And so it was that low cost of credit that drove up the price of assets. The most tangible example is real estate. We saw Orange County go to a point that a starter entry-level house of some kind, either attached or not attached, is close to $1 million. And, so how is it you can afford that? Well, people don't buy a house for $1 million and 900,000. They buy a house, how much down and how much per month. And if you lower that interest rate down low enough, the value or the price of that house gets pretty high, and that's what we've done. So in 1983, inflation peaked at 18%. Paul Volcker was the chairman of the Federal Reserve at the time, and the Fed funds effective rate hit 22% or higher than the rate of inflation, because Volcker knew if you don't get the cost of credit above the rate of inflation, borrowers will continue to borrow because there's an embedded advantage to doing that. And of course, this was controversial, and it was an issue. Probably the only saving grace is the average house in 1983 sold for, I don't know, $79,000 or $89,000. They were a lot less expensive than they are today. And we can see how the Federal Reserve in this chart, the upward sloping red lines is where the Federal Reserve begins to increase interest rates because of inflation beginning to escalate. And we can see that interest rates move up. The gray bars, the vertical bars, are periods of recession. So we've got a run-up inflation, we've got a recession. Then you go for a period of time, there's a run-up on inflation and interest rates, and then a recession. And so we can see this happening in a somewhat consistent manner over time. Is that same chart, it's just looking at it a little bit more to the right. And one thing we can see is there's generally a sloping index down, and these periods of run up in interest rates are followed by sharp decreases in interest rates. And so the Fed will increase rates, the economy will break, they'll drop the rate. They increase, we go into a recession, they drop it. And so in each period of recession, we can see a sharp drop off in interest rates. Again, if we look at this, we can see the slope downward. And what this tells us is, going back to 1983, the Fed didn't have to increase rates very far to break the economy. So in each case, they moved interest rates higher. In this particular case, interest moves up to 10%, for example, in about 1989, and we broke into recession. We go down to 2000, we went up to about 6.5%, and we broke into recession. Later on, 5.25%, recession. And we continue to slope lower, showing that the economy is going to be more fragile. It can't stand much increase in interest rates before it breaks into recession. And so in each case, it's trailing down. What we see here most recently is inflation, or CPI, is kind of running outside of the historical realm. Now, this chart shows historical core CPI. Remember, I talked about that before. This goes all the way back to 1979. And there again, we can see CPI maxing out at pretty low levels. So the Fed would raise rates, would go into recession, it would drop. So CPI has been relatively low, something in the 2.5% range for quite a while, up until recently. And recently, it has run completely off the rails. But keep in mind, at no point in this historical context did we print $5.2 trillion in liquidity and inject it into the marketplace. So if you do the math on 6.4% core CPI, and you tax affect the cost of interest, you would go to about a 12.9% average cost of interest in order to slow the economy and make a penalty for the cost of credit, or a positive cost of credit. So the question is, are we going to see a 12.9% cost of credit? Is that likely to happen? Are we going to revisit 1983 and ramp up to those levels? And my quick answer is no, I don't see that happening. I don't think it'll happen. And this is the reason why. In 1983, the U.S. had a total of $1.3 trillion in total debt, total federal debt to the public, $1.3 trillion. By comparison, today we have $31.4 trillion in debt, or 30 times what we had in 1983. And as a net result, it's more fragile. So think of it in terms of if I owed somebody $100 and they said, well, I'm going to raise your interest rate from 5% to 20%, fine, no big deal. It doesn't represent much money and I could pay it. If on the other hand, I owed them $1 million and they just went from 5% to 6%, that's a big deal. And I may not be able to afford the cash flow to pay that. So just the nominal debt basis is slowing down the amount of debt of credit rate we can increase, or interest rate. This is that same chart, but instead of looking at total dollars, it's looking at it as a percent of GDP. So in 1983, the total debt represented 32% of GDP. So think about it. Think about how much you make over the course of a year. And if I had that amount in credit card debt, well, that's still a big number. Most recently, debt to GDP peaked at 135% of GDP. So think about that same equation. How much money do I make per year? If I think about that as credit card debt, that's a big number. And that's what we're dealing with. And an increase in interest rate can be devastating. There's some other issues at play. I don't know if anybody's heard about this, but the BRICS coalition. So for westernized countries, we have what's called the G7, and that is an association of westernized economies. And we get together and we talk about how to collaborate on economic things. And so in 2000, the BRICS was created, and BRICS is an acronym for Brazil, Russia, India, China, and South Africa. And they created a coalition that said, you know, America's beating us up, let's get together and cooperate on economic activity. Now then, recently, Saudi Arabia has applied for membership in the BRICS, Algeria, Argentina, Mexico, and Nigeria. Some of these are pretty big economies that are joining into this association. And equally importantly, there is discussion about the BRICS issuing a separate currency, which is gold-backed. One of the criticisms in the United States is the Federal Reserve was able to crank out $5.2 trillion in new dollars because there's no gold backing to it. It's what's called a fiat currency. And in 1972, Richard Nixon abandoned the gold standard for the US dollar, and at that point it was allowed to just float. And it floated somewhat under control for a long time, but most recently, with the actions of the Federal Reserve, it has gotten extreme. So, number one. Number two, the United States has imposed sanctions on Russia because of their expansion of hostilities in the Ukraine, and said that Russia cannot settle oil sales transactions through the Federal Reserve SWIFT system. And so we said, Russia, we're going to block off your ability to sell oil. Well, the whole world wants Russian oil, and frankly, they'll trade camels for it if they need to in order to get that oil, and that's where BRICS comes in. China is a big buyer of Russian oil, and they can settle in gold-denominated BRICS currency. And there is an effort afoot. Now, some folks would like to go into a trend of what's called de-dollarization. The US dollar is the reserve currency for most of the world. And a lot of countries like Russia and China are not happy about that because the strength of the dollar is having a toll on their ability to raise prices. And so one of the solutions on this is de-dollarization. We'll begin to settle transactions in the BRICS currency. India, most notably, has begun to settle transactions with Russia for oil. Uniquely enough, we say we're not going to buy Russian oil from Russia, but we'll buy it from India. So, okay, that's interesting. Now then, you know, this part, and I'm getting slightly off track, but if you look at parallels, 1920 versus 2020, it's kind of interesting. So in 1920, there was a period of rapid technological development. It was primarily the internal combustion engine. Now it was developed or patented in 1897, but it really started to get some legs under it in the early 1900s, around 1920. And you can see a lot of technological and mechanical innovation, machine tools and building things and development of airplanes, etc. In the 1920s, this just took off. Similarly, in the 2020s, we see development of information technology. And it's not mechanical, it's not the internal combustion engine, but it's other forms of electronic innovation, primarily information technology, and rapidly evolving. One of the current conversations is on AI, where I'm having conversations and discussions with a computer. It's not a person, but I think it's a person. And so both periods of time had rapid innovation. Pandemics. 1918, the Spanish flu pandemic outbreak happened. There's some speculation that it was SARS-CoV-2 that wasn't in an earlier version. There's estimates that between 20 and 50 million people died worldwide, and it lasted for 2 years. It was interesting to me. There was a lot of pushback. There was a lot of controversy about how to mitigate this, what to do, what not to do. There was the anti-mask coalition of San Francisco that was formed because they felt masks were unreasonable, etc. But at any rate, that pandemic lasted about 2 years. In 2020, we had the COVID-19 pandemic outbreak. About 7 million people died worldwide, and that lasted about 2 years. Kind of interesting how close those were to 100 years apart. Banking panic. In 1907, there was a banking panic, led to a lot of runs on banks, etc. And it was that 1907 banking panic that led to the 1913 Federal Reserve Act, which created the Federal Reserve as a lender of last resort to the banking system. In 2023, we've got a banking panic, and the Federal Reserve is coming to the aid of the banks with term funding. Again, about 100 years apart. War. In 1914, the First World War started in Western Europe, and of course, Germany, France, England. Western Europe, there was fighting amongst them, and the United States was not involved. Eventually, the United States did become involved in that war. 2014, Russia invaded Ukraine. And there's a tendency to feel like, wait a minute, that's recent, that's 2022. Now it was the escalation in 22. The actual initial incursion into Ukraine was 2014. So amazingly enough, 100 years apart. Immigration. It's kind of interesting. We think that's a modern thing. You know, the United States wants to preserve its status. It doesn't want a lot of foreigners coming into the country and taking its assets and its jobs and that sort of thing. In 1923, there was what's called the Anti-Chinese Immigrant Act. And it was designed and put into law for the purpose of reducing the level of immigration of Asian people into the United States, focused primarily on Chinese, but also others. And so immigration is not a brand new issue. It's an issue that's been around for a while. And again, about 100 years ago. Today, of course, we have lots of topics on immigration and border and enforcement of border, etc. So these 5 things, what we can see, I think, is that on one hand, a lot has changed. On the other hand, things haven't changed very much. We're still tending to do a lot of the same things. Now, if we look at things that haven't changed between 1920 and 2020, the average household income. In 1920, the average household income was $3,200 a year. That's the entire household, mom, dad, everybody. $3,000 per year. By comparison, in 2020, it was $70,000. And so, you know, what changed? Well, inflation changed. That's what. And escalated things pretty significantly, as we can see. If we look at the average home price in 2020, the average home price was $6,300. My grandfather was a home builder, and he talks about selling houses that, in his case, $16,000, but a whole lot cheaper than it is today. Today, the average home price nationwide, $552,000. So, you know, what has changed dramatically? Well, the buying power of the US dollar has changed dramatically, and it doesn't buy as much as it used to. And so, in my opinion, inflation has been ramping up, and the recent actions by the Fed will cause it to ramp up much more. So, not long ago, I gave a presentation like this, and somebody in the audience, one of my friends, raised her hand and said, "All right, Dan, that's all well and good, but how's our bank doing?" And okay, so I put in a new slide to address that. So at the end of the first quarter, which was the end of March, just a month ago, the bank had 25% of its total deposits in cash. So not that we expect 25% of our deposits to be drawn on, but if that were to happen, we've got that much cash on hand. We don't need to make phone calls. We don't need to do any credit transactions. It's just there. And in addition to that, the bank has $238 million, or 70% of its deposits, if we consider additional lines of credit available from the Federal Reserve, Federal Home Loan Bank, correspondent banks, etc. So quite a bit of liquidity on the part of the bank. Loan to deposit ratio, 55%. You know, we talked earlier about the issue with First Republic because they had a fairly large percentage of their total assets in loans. Without as much liquidity. In our case, we've got less loans than some other banks. Of those loans, thankfully, we had zero delinquency at the end of the first quarter. That means none of our loans were more than 30 days past their scheduled payment date or maturity date. So very pleased about that. Zero delinquency. It's really kind of nice. But I'm a paid professional worrier, and so I keep worrying about that. Total earnings in the first quarter were up 30% as compared with the first quarter of the prior year. They were down slightly from the fourth quarter, but they were up from the same quarter last year, 30%. We had a record number of total assets at the end of the first quarter, and Bank Oreo, that stands for other real estate owned or property that we have foreclosed on. And the bank had no foreclosed properties, no properties in process of foreclosure, no properties in process of collection. So credit quality is good, liquidity is good, performance of the loan portfolio is good. So very pleased about that. Now, I'm not ready to spike the ball yet and say, aren't we great? Because, you know, next month's a new month. But as we look at the end of the first quarter, this, by the way, is our Tier 1 leverage ratio. And that measures your capital as a percentage of your total assets. And capital is our money, shareholder money, that protects depositors. And what we can see is that Tier 1 capital has been increasing since this time last year. We're at 9.86%. We're at 10.56% at the end of the first quarter. So a good Tier 1 leverage ratio. Now, if we look at the net interest margin as a percent, we can see that in the fourth quarter, we were at 3.56%, and we did decrease a little bit by about 23 bips, but not nearly the kind of drop-off that we saw at First Republic and some of the others. And part of that is the average time to our loan reprice. Keep in mind, we make primarily commercial loans to small businesses and high net worth individuals. Our average time to reprice is 2.7 years. Now, what I mean by that is we will make a 10 or a 15-year final maturity loan, but there is a reprice trigger every 60 months within that loan where we reset the interest rate. And so our average in the portfolio is 2.7 years. It's not a long 30-year extension to reprice. So we have the opportunity to float with the market, increase or decrease interest rates as market demand dictates. We've got a low average loan to value ratio, about 47%. So if you think of the value of, let's say, a piece of commercial property is 100, our loan in that example would be about 47. Some are slightly more, some are slightly less, but the average is about 47%. We've got low historical credit losses. Fortunately for us, the highest credit loss we ever had in any one year was 99 basis points, just below 1% at the height of the Great Recession. So low historical credit losses. Our allocation for loan loss reserve, it's now ASC 326 to CECL, about 2.54% of total loans. So keep in mind, our historical losses have been low, but our loan loss reserve is provisioned pretty well for any unforeseen events. So if we did begin to have credit problems, we have set aside quite a bit of money to be able to adjust or to recognize those losses. And then finally, CRA. Now, one of the issues, topics, the areas of concern or focus is our bank emphasizes commercial real estate loans. And the reason we emphasize commercial real estate loans is they're tangible. Many other banks will make unsecured loans or loans collateralized by inventory or accounts receivable, that sort of thing. The problem is that requires a level of record keeping that many of our smaller borrowers don't have. And so we will collateralize in advance by a position on commercial real estate. And when we say commercial real estate, everything that's not a house or a condo is commercial real estate. That includes churches and hotels and 7-Elevens, you name it, everything except for a house or a condo. And I think one of the risks these days is some of the talking heads on the news feed say, oh my gosh, commercial real estate's terrible, we're in trouble with commercial real estate. Well, that's a pretty broad brush. What is the loan to value? What is the location? What's the cash flow and debt service coverage? What is the advance as a percentage of that class? So we can't just, with a broad brush say commercial real estate's bad or residential real estate's good. We go through periods of trouble on both, but we'd like to think with a well-structured loan and close attention, we can weather those storms better, we hope. So with all that in mind, what does a forecast look like? So many economists will give you projections, but when it comes to an economic forecast, they say, well, it could be this, could be that, could be the other. So I'll throw out my opinion. Keep in mind, this is Dan's opinion. So I think the Fed will adjust rates higher 1 or 2 more times based on the commentary that they delivered last couple of times. Keep in mind, we have a 6.6 inflation rate and 5.25 Fed funds rate. So today, we're creating an incentive for people to borrow. So I think they'll continue to adjust. I would watch for expansion of the BRICS and de-dollarization of world currencies. That will have a tendency to cause the dollar to repatriate, meaning coming back. Keep in mind, over half of the dollars in circulation are in other countries. So they're part of the central bank of Dubai or, wherever. And if de-dollarization really begins to take off, those dollars will begin to come back to the United States Federal Reserve, and it will add to that monetary base. It could add to it by as much as doubling, if in fact all the dollars were to come back. If we double the monetary base again, inflation could become a very significant issue. My guess is look for an event. And an event will be something. It may be expansion of Russian aggression in the Ukraine. It could be limited nuclear offensive in the Ukraine. It could be an aircraft carrier parked off the coast of Taiwan. It could be North Korea launches something into somewhere. Of course, in the Middle East, there are a lot of tensions there. So I would look for an event. And, if you think the Federal Reserve is not political, that's a facade. The Federal Reserve is very political. And we are beginning to go into a recession. The Fed will want to get out of this. They won't want to take the podium and say, ooh, we blew it, man. We printed too much money, and then we raised rates too fast, and now we crashed everything. They'll never say that. They'll say, in light of the events, we need to go to a quantitative easing policy, lowering interest rates and expanding the monetary base. And so I would look for an event. And then QE following that. So the Fed will be stimulative to the economy. And unfortunately, at that point, I think we're looking at a hyperinflationary trend. And when I say hyperinflationary, I mean, the sorts of 18% that we talked about before. And even though in my lifetime in America, we've never seen that, we've seen other westernized economies that have done that. The most notable being Germany prior to World War II. They had an inflation rate in excess of 3,000% per year, and which directly led to the conflict which resulted in World War II. So hyperinflation can occur if you print enough money, and my fear is we're starting to do that. And then look for de-dollarization after a hyperinflationary period because people want to get out dollars. So, what do we do with it? Now, I realize this is a bit of a scary concept. I'm talking about, a decrease in value of savings, but there's potentially an increase in the value of assets. So my general philosophy would be to invest in the means of production. And means of production means how do you get the things that you need to live? And the most notable of that is farms. We can't do without farms. Got to eat. And all right, so who's buying farms? Let me see, Bill Gates and China. Okay, why are they buying farms? Not because they're sloppy. So farm factories, and when I say factories, I mean factories that produce things we need. If tensions continue to increase, manufacturing will come back to the United States, and no longer can we simply buy. I bought a whole bunch of pens. I think I bought 12 of these things for about $2 each. There's more than $2 worth of metal in this pen. If we have to begin to produce them in the United States, we're going to have to produce manufacturing for them. Real estate. I think real estate is fundamentally a good investment. Now, having said that, I wouldn't rationalize going out and buying a $10 million house because it's going to go up in value. The house where you live is where you live. You don't do it for investment purposes because you'd have to move into a tent and realize that. But income producing real estate, I think, is a sound investment. And producers of basic products. For anyone who likes Warren Buffett, so one of Warren Buffett's favorite stocks for many, many years was Coca-Cola. And was Coca-Cola an essential item? Well, no, not really. I don't need it to survive, but I like it, and so I'm willing to spend my resources to buy it. And he's done very well on Coca-Cola. So when I say produces a basic product, it doesn't have to just be water and food. It can be other things that we also choose to consume. I would be careful about dollar-denominated income. So what I mean by that is if you make a contract whereby you're going to receive, let's say, $1,000 per month on going forward, and we assume that'll be enough for me to retire on, as inflation kicks in, that $1,000 will get to be less and less and less, and pretty soon it won't buy what you thought it would. So I would be very careful of dollar-denominated income. On the other hand, I would prefer dollar-denominated expenses. So I will buy your widget for X number of dollars per month over time, because as time goes by and inflation takes hold, the value of that will decrease. And so what I want is dollar-denominated expenses that are getting cheaper over time. And I want asset valued income that gets more expensive over time. And then, that's summarized by prefer assets over cash, because cash is decreasing in value and assets are increasing in value. So with that, we'll open it up for some questions. You may have hit the chat button and sent something to Glenn, in which case maybe Glenn could relay those questions on to me. If you wanted to raise your hand, we can unmute people, and let's ask some questions.
All right. Well, Dan, I think a lot of people joined after we gave the instructions on the asking a chat question. So at the bottom of your screen, you'll see what looks like a little idea there. It's a chat. So you click on chat, and you're going to have two options. You're going to want to send it to me. My email address, gcottle, and I'll be filling these, and we'll get asked what we can.
Also, I've clicked the authorize unmute all. So if you clicked your unmute button, you'd be talking. Glenn, did we receive any questions through the chat?
I don't have any questions at this time.
Okay. All right. Anyone else want to be bold and unmute yourself and ask a question? All right. Well, it sounds like we don't have a lot of pressing questions. We're up to the 55-minute mark, so amazingly enough, we may finish on time. Very pleased about that. Well, guys, I appreciate everyone joining. Hopefully this was helpful. It's kind of difficult to compress everything in such a short period of time, but hopefully this helped. We are here all the time. If for some reason somebody didn't ask a question, didn't get an opportunity, couldn't figure out how to unmute or something else, feel free to give us a call. We'll be happy to talk it through and continue to work on these things. I think the key thing is, even though it's easy to get nervous about all these things we're looking at, fundamentally, I think the United States has got a lot of hardworking people, and they're innovative and entrepreneurial. We can make things and build things and export things and do all kinds of great things. And so I'm generally optimistic. I'm a little more critical of some of the government. I think they overspend on things that I wouldn't spend on. But anyway, that probably leaks out in some of my comments. I wish we could get a little more restraint in spending on the part of the government. But anyway, that's just me.
All right, Dan, I think we have a question over at the Ontario branch.
Mm-hmm.
Yes, thank you. Hi, Dan. It's Mike Mendonça.
Hey, Mike, how you doing?
I'm doing fantastic, sir. Thank you. Hey, number one, let me just start with saying thank you for hosting this event. Very informative as always. I love listening to you and just your expertise and just your intelligence over the many, many years that I've known you. So very grateful for you. So thank you for that. I have a couple of questions that I'd like to pose to you. With all this stuff going on with the BRICS and with the de-dollarization, I follow it as well. I'm not concerned. I don't stress over it because I can only do what I can do as it comes, right?
That's exactly right.
With our investment strategies moving forward, I am just coming into a position where I'm going to have more money available to do other things. And maybe something that I can ask of you guys, of my bank, is to maybe start a process where you guys have different options for us, maybe investment vehicles to utilize.
Okay.
So I trust you guys. I trust you as the leader of the bank. So I would feel safe about parking money and investments here, as opposed to other banks that we know that are involved in these weird investment strategies that they have. So I have total confidence in you guys and in you as the leaders. So maybe that's something that you guys can think about, different investment vehicles for us as your depositors or as your businesses. You know, that would be my question. If you have something down the road that can help us as your customers.
That's great. So on that, and thank you for the kind words, Mike. I really appreciate it. By the way, if anybody's got a leaky roof, call Mike. So the issue with investment securities, that's a separate licensing, and the FDIC is really fussy about that. In the early 80s, some of the larger banks, First Interstate and others, began to offer securities, and customers said, well, gee, I thought that was a deposit. I thought it was FDIC insured. I didn't realize it was stock and it would go down in value. And it became a real kerfuffle. And so the FDIC now is really sharp on that point. And if a bank is going to, or bank holding company is going to invest or own an organization that provides investment advice, it has to be at a different physical address. And it has to say clearly, not FDIC insured. And so it creates some layers on there. And but having said all of that, we do business with some very good investment advisors and some people I would trust. And perhaps we can start to work cooperatively with some of these folks that can, that's what they do. And we can, give a name and a phone number and that kind of thing and help that way.
Okay, awesome. Thank you, Dan.
Well, you're welcome. Appreciate it. Glenn, anything else?
I haven't seen any other questions come up.
All right. Great. Well, with that, guys, it's 11 o'clock, and one thing about every businessman, there's not enough hours in the day, so I want to respect that, and thank you for joining. I really appreciate it. Feel free to give any inputs. Was this good? Was this not good? Was it helpful? Would you like to do more of this in the future? Honestly, I could talk about the economy forever. So if you'd like to do more of this in the future, either let the host know or let your local banker know, and we'll take it from there. All right. With that, I'm going to sign off, and thank you very much. I really appreciate it.